from the Fed's perspective, no matter how you look at it, inflation's too damn high. And as a simple example, if you take over here on the left hand side, this Jason Furman table, which he puts out after every series of inflation data, what you see is if you look at that table, every single number on that table is too high for the Fed. No matter how you slice it, inflation is too high. And you can slice and dice it all the different ways and all the different uh, hope that it might be close, but none of those numbers are 2% on that table. And if anything, what it's showing is that inflation is moving in the wrong direction, not the right direction across nearly all of those measures. And why that's happening, I think what you can see here on the right hand side is the breakdown of how much of that inflation's occurring from the cyclical contributions versus the acyclical contributions. And what it shows is that cyclical contributions are stabilizing in terms of their contribution around 2%, which is consistent with some moderation from the extremes that we saw in the post-COVID period, but largely consistent with with a dynamic that with a relatively late cycle, relatively tight economy. So you're seeing that stabilize, and that's stabilizing at about a point above where it was in the pre-COVID period. And then I think probably the most important dynamic here that's happening is that we've seen the end of the disinflationary impulse from the acyclical side of the economy. That acyclical side of the economy, which was so critical to creating the downward disinflationary force in measured inflation over the course of starting at the end of 22 and into 23, that is bottomed and is now starting to rise. And I think it's important to recognize that that when you look at this acyclical contribution, the peak negative impulse, disinflationary impulse in that measure, basically aligned with the Fed suggesting that they were going to pivot. And so what they didn't recognize at the time was that that big disinflationary impulse was not likely to be sustained. We had a high rate of inflation as supply chains seized. When supply chains got resolved or have been, on in the process of being resolved, that created a big disinflationary force. But eventually that will slow. And the question is basically what level do we reset the acyclical inflation at? You know, through the course of the 2015 to 2019 period, we saw it average from a contribution perspective at about 0.5%. But if we have an environment where deglobalization is happening, where there's greater parallel supply chain creation, where investment continues to be relatively elevated in order to deal with those supply shocks, and where the several decades of integration that we've seen are starting to fade. Not to mention, I should say, the fact that there's pressures on commodity prices as a function of increased global conflict. The odds that we see acyclical inflation stabilize at that 0.5% that we saw in the pre-COVID period are pretty low. I mean, even just a move of acyclical inflation back to what we saw in the pre-GFC period, where it averaged about 1.5%, combined with cyclical inflation at roughly 2%, puts you in a position that first looks a lot like what the overall inflation measures look like, and second creates a lot of risk that the Fed can meet its mandate in the near term.